Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. This week, the U.S. Risk Demand Indicator, USRDI, flipped back positive after turning negative and signaling risk off in March. The official reading is plus 0.01, which is slightly positive but enough to signal risk. As tensions eased, the stock market has rebounded sharply off the April 8th lows. USRDI is built to identify longer term cycles where the risk reward is unattractive. Past risk-off signals have coincided with significant events, including the 2002 accounting scandals, 2008 financial crisis, 2011 U.S. debt ceiling, 2015-2016 industrial slowdown, late 2018 Fed tightening, 2020 COVID shock, and 2022 rate hike sell-off. This event has been unique regarding its global impact and unpredictability, tweets, news interviews, etc. Given the fluid backdrop, USRDI could fluctuate between risk on and risk off in the coming months. For now, we will remain data-driven as we track USRDI, asset class trends, and news headlines through month end before adjusting ratings or portfolio allocations. Key takeaways. 1. The big news last week was the US-China trade deal. The two countries agreed to a 90-day pause in their trade war, easing tensions. As part of the agreement, the U.S. reduced tariffs on Chinese goods from 145% to 30%, while China cut tariffs on U.S. imports from 125% to 10%. Despite the pause, some tariffs remain in place, such as the U.S.'s pre-existing Section 301 and 232 tariffs. Implication: the pause relieved global markets, boosting investor sentiment and triggering a cross-asset rally. The S&P 500 jumped plus 3%. Oil prices rose as the economic outlook improved, and gold fell 1.5% as demand for safe haven assets declined. 2. The Trump administration has agreed to multiple 90-day pauses to ease tensions and allow negotiation time, but key protectionist policies remain. A 10% baseline tariff applies to most imports, with additional aluminum, steel, and auto duties. The pauses are temporary and staggered. The suspension for most countries runs through July 8th, while the agreement with China extends through mid-August. Implication: the pauses offer near-term relief to businesses and have eased market volatility, but unresolved structural issues could trigger renewed tensions once the pauses end. 3. The trade war is moving to the next phase. The first phase, marked by de-escalation, is over. Tensions have eased significantly since early April, removing the worst-case scenario. Now the market moves to the next phase of the trade war, assessing the economic and earnings impact. Implication: the market will shift from reacting to headlines to analyzing the effects, which won't show up in the data for several months. Unfortunately, the data is likely to be noisy. 4. Survey-based indicators, which capture sentiment and expectations, have weakened significantly as policy uncertainty weighs on consumers and businesses. Meanwhile, hard data, which is lagging, shows no significant deterioration. Implication: sentiment can influence behavior, but hard data drives corporate earnings and economic growth. The question is whether today's downbeat outlook will translate into fundamental changes in spending, hiring, and investment decisions. 5. Financial markets have round-tripped since early April. The S&P 500 has gained plus 5% since March 31st and reclaimed its 200-day moving average. The Nasdaq 100 has staged a rebound that rivals the pace of its COVID-era recovery in March 2020. High-yield corporate credit spreads have erased their spike. Implication: the market appears to discount the soft data and place a low probability on a growth slowdown. 6. Two themes point to continued volatility. First, this week's portfolio strategy report shows periods of weak soft data historically lead to higher volatility, negative EPS revisions, and below-average returns. Second, our U.S. Risk Demand Indicator, USRDI, is positive but sitting near zero. As highlighted on P.9 of the March 2025 USRDI primer, negative readings are historically associated with increased market volatility. Implication: expect volatility to linger despite tensions easing. The events to focus on this week are Tuesday, May 20th, the G7 Finance Ministers and Central Bank Governors meeting begins in Banff, Canada, May 2022. Discussions will focus on trade tensions, currency volatility, and global economic policies. Wednesday, May 21st, the UK Consumer Price Index, CPI, for April. Investors will monitor this for insights into inflation trends and potential Bank of England policy responses. Thursday, May 22nd, the U.S. initial jobless claims, a key indicator of labor market health and the U.S. existing home sales for April, provides insight into the housing market's performance. Friday, May 23rd, the U.S. new home sales for April, another vital housing market indicator, and the University of Michigan Consumer Sentiment Index, final for May, measures consumer confidence, which can influence spending behavior. Stay well, stay invested. Schedule a time with us if you would like a second opinion on your financial situation. Thank you for listening. For additional information, please visit mraadvisory.com.